Yo, what's up guys? Welcome to my channel. Today is day 2 of part 2 profitability. So right now I'm looking to trade the London session, and before the trade and setups and all, I would like to give a small explanation about the recent correction in gold. If you see, gold was on a very bullish trend in the last couple of months, and recently in the last week it gave a huge correction, about 21% correction, and most of the traders or most people think this is a war impact or this is geopolitical influence. Sure, that is the case, but as a trader you should think like an investor. And where is money flowing? Sure, gold is a safe haven, and you know people look for gold when there's uncertainty, but that's not the case. We have to look over US dollar and how it's performing too. If you see, recently US dollar has been going up, and this is not the reason gold is dropping. But if you see, gold, let me just write this down so that I remember, and it's very important. You see, gold is a safe haven. It people look at gold when there is uncertainty, and that's when it acts as a store of value. But here's the case: gold doesn't pay any yield, meaning it doesn't pay any interest or any kind of return. All the return which people make is based on demand and supply in gold. So people don't get any yields. And what do investors look at? Investors look at yields, return, and holding. So why would investors not really hold gold when the inflation is going higher in the US dollar? Because they get the opportunity cost. See, opportunity cost. Holding foreign exchange reserves on of the US dollar would pay them yield. But this is not in every case, because the Fed decides the yield rates, and when the yield rate is going high, and inflation is going high, the US economy is strengthening, controlled inflation. Along with it, the real yield is nothing but yield after adjustment to inflation. So when both of this goes hand in hand, investors get better returns on holding foreign exchange reserves of the US dollar. US dollar pays more, simply. So how do we as traders can recognize this? Very simple. You should go to TradingView and search this particular symbol, and you'll come up with a graph on the daily time frame. So this is the real yield that investors and funds managers and all, they get paid for holding the US dollar, because it pays interest and it pays yield. So if you can see, this is the yield adjusted to inflation. Like apart disregard to the inflation, this is the real yield. So when the real yield is going up and the dollar is also strengthening, then why would someone like to hold gold? Because it doesn't pay any yield and there's a lot of uncertainty. This is one of the major reasons gold is giving a correction, and you should generally look at different aspects when it's gold, because it's a different asset. It's not gold versus US dollar, but it's about many other geopolitical factors too. But this is how I check my fundamentals in gold. It's very simple. Holding foreign exchange reserves of the US dollar pays more at the current situation. So that's why investors are looking to drop their money, because if you see, they had a nice rally and they can book their huge positions due to this massive spike. They can just book positions and get on to holding the US dollar, because the decisions taken by the Fed and also the real yields hiking can be one reason, because there's more certainty and more opportunity over here. So that's the fundamental analysis behind gold's correction. And if I take any trade in this London session, I'll record that and upload it as part 2 of today's continuation.